All right, welcome everybody again to the weekly Stride Live. Today, joined once again with our tax expert, Morgan Holmes, to talk about how to transform your personal expenses into business expenses. What are the requirements? How do you calculate those things? When you have simple or mixed use costs, for instance, home offices, how do we integrate that into a tax saving strategy for our clients, or especially for MSP owners will be the focus today. Morgan, thank you for joining us again. How are you?
Good afternoon and hello again.
All righty. So Morgan, we'll get right into it. Transforming personal expenses into business expenses. What's the first one? What's one that comes to mind? I think in the remote working world, probably would say business use of home. How do you take the home office tax deduction, or what are the considerations with that?
Yeah, so obviously that's the first one we're going to talk about. It's probably the most prevalent personal expense that people are taking, especially post-COVID. And for business use of home deduction, what we would be looking for is exclusive and regular use of an area in your home. The way that we would take that deduction is we would look at all of your home expenses, mortgage interest, property taxes, rent, insurance, anything like that, anything related to the home. And then we would take the square footage of the area that is regularly and exclusively used for the home or for the business, divide it by the total square footage of the home, and apply that percentage to all of those expenses that are applicable. Again, mortgage interest or property taxes, rent, all that stuff. So very, very common.
Got it. So what are some limitations with that? I mean, obviously, you probably can't have it 50-50, where you use the office sometimes for personal use and sometimes for business use. For instance, playing video games or watching movies. How does a business owner in their home make sure they're following the right protocol?
Yeah, so it really is the amount of square footage that you're regularly and exclusively using for your business. So, if you're using your dining table during the day for business and at night for personal use, you're probably not going to be able to get a whole lot of square footage out of that. But if you have a separate room in your home that is your home office and it's only used for your business, and it's not a spare bedroom or guest bedroom or something like that, then you're in pretty good shape.
Got it. And you said there's two ways to calculate that, right? You said you can do the simple square foot method. I believe it's $5 a square foot, and then the regular method of actually accounting for all the related expenses. Is there a limitation to either, or what does that look like?
On the simplified method, there's a limitation of $1,500. Um, we really see this being a huge deduction anyway, but we typically will use the regular method in computing the home office deduction. It generally yields the bigger deduction.
Got it. So essentially, hey, 300 square foot in 1,000 square foot house, and then you're going to do the 30% of the home is used for business, and then calculating 30% of your cell phone bill or internet, and so on.
Yep, that's right.
Cool. And if I understand it, I'm hoping everybody else can understand it. That's good.
Yeah. It's not that challenging to understand. It's just gathering the data and just putting on a tax return.
Documentation. What type of records should they keep? Do they need to keep every phone bill, or is it a worksheet or a document that shows where they're classifying from? What would you recommend?
So I mean, obviously you should keep everything just in case you get audited, right? But again, I think documentation of the area of the square footage you're using is probably a good idea. But as with anything in the tax world, documentation is very important.
Got it. Of course. What about limitations? Can employees do this? Can they do a deduction for this? Like, let's say you have an employee who wants to do this.
So they can, but you'd have to do a reimbursement, and we'll get to the accountable plan part in a little bit. But yeah, an employee can do it. The employee cannot take a deduction if the employee is not being reimbursed for it. So, and we'll get to that as well.
Got it. What limitations? What other limitations with personal business use of home?
Yeah, I mean, again, it's just just be reasonable and don't try and grab everything and throw it in there as a deduction. So, and again, that simplified method has a limitation on the amount you can do.
Got it. Got it. So are there certain expenses? Let's say I get a new desk, a new chair, a new monitor. Would that just fall under a normal business deduction, even though it's in my house, or what does that look like for use of home?
So if you're a business owner, the business should be paying for those assets. If you're an employee, then the business would pay for those assets and reimburse you for the cost of those. But essentially, they become the business assets.
And then any impact if you sell your home? Let's say you've been in the same house for 10 years, you've run a successful business. Is there any implication on that sale of the home of
There,
having a home office?
there is. So when you take the home office deduction and you're a homeowner, you will be picking up a little bit of depreciation on the home. When you sell that home, typically there's the $250,000 or $500,000 exclusion on the gain on the sale of the home, whether you're single or married. When you rent out the home, the depreciation you previously took, or if you're taking the business use of home deduction and you're including depreciation in that, the depreciation that you've previously taken then becomes a recaptured item, and the gain gets split between capital gain and ordinary income. So if you took, for example, if you took $5,000 of depreciation on the home as a home office deduction, and you sold that home for $1 million and had a $500,000 gain, 495,000 of that would be excluded, and $5,000 of that would then be recaptured and included in your.
Got it. Got it. So that's just a very specific situation, but definitely something to consult your tax professional with to make sure they're aware of it. If you have any sale of the home, just make sure you talk with your tax professional on both a personal and business side. So I think MSP owners, a lot of them work from home, but there is a huge component. They're on the road, and many MSPs use their home or their personal vehicle to travel to client sites. What is the opportunities for deductions for mileage or for vehicle expense? What does that look like for an owner?
Yeah, so similar to business use of home, business use of automobile is another pretty standard deduction that we take for owners of our businesses. Again, it's based off of, everything's based off of mileage, right? So your options are, take the standard rate times the business miles driven, or take actual deductions, fuel, lease payments, if you own the vehicle, depreciation on the vehicle, etc. So the calculation for using standard mileage is pretty easy. It's business miles times the standard rate. For using the actual expense calculation, again, we use miles. So we would use, business miles divided by total miles driven times all of those expenses in determining what the actual expense to be taken on the tax return is.
Yeah, and for an MSP, sometimes you see they'll have their own company vehicles or trucks or vans, or maybe the business owner has their own personal. What is the advice if they say, let's say they have a fleet or they have a couple company vehicles, probably going to be staying with the actual expense method, right? It's probably going to supersede the mileage and be a lot easier to track, I would
Oh
assume.
yeah, and it'll yield a bigger deduction too. So,
Yeah.
the depreciation on the vehicle gives you pretty significant upfront deductions after you purchase it. So usually, I can't even think of any business clients that I have that use the standard deduction or standard mileage rather for automobile expenses. It's almost always actual expenses.
Got it. Yeah. I think it all varies, especially if you're not a heavy driving business. But yeah, I think the mileage rate's just easier. You get in the car, you start your tracker, you check it, and then you keep those miles. But you're definitely going to get more when you talk about, hey, we're buying a fleet of vehicles. You might be a consulting firm where you're actually doing a lot of local travel, or you might be an MSP where you need electric and wiring trucks. So definitely look at what the opportunities are. And then let's say they have a surplus at the end of the year and they're looking, should they look at buying a vehicle and they'd be able to take that, or since it's depreciated it might negate the value of buying it in that tax year?
No, I think if you need the vehicle and and also need a tax deduction, yeah, you should look at purchasing vehicles, right? I think if you're not in need of a vehicle and you just go out and buy one to get the tax deduction, probably not a good use of your funds, right? So really it's just what's the need, and if you have that need for a new vehicle, the year end would be a great time to purchase it because you then capture that deduction in the year you purchase it and place the asset into use.
Got it. Let's say let's say I'm an MSP owner, I buy a truck and I decide to do the mileage deduction or the standard mileage rate method, but then year two or vice versa, are they able to change back and forth between how they take that deduction?
You can, there's limited opportunities to do that. So, if you choose the mileage method, you have a harder time, or you can't actually go to the standard or actual deduction. But if you exhaust the depreciation and all that, you can then flip over to the mileage.
Got it. Got it. So if you're purchasing a vehicle brand new, I would say it makes more sense to go with the actual expense method. What about if a business owner is like, what's the biggest consideration? I can see, hey, they're using it and maybe doing 50% of the time I'm driving for work, 50% of the time I'm driving for leisure, but I'm assuming that's probably not good enough for record keeping to just give a generality. What are some of those considerations they need to be keeping in mind?
Yeah, you definitely need to be maintaining a mile log. Typically we'll see people either writing it down on a piece of paper or in a spreadsheet, or actually using a software platform like MileIQ to
Got
track
it.
miles. Yeah, but
Makes sense.
it's important. If you don't have that, you definitely are at risk of losing your automobile expense.
Got it. And I always hear about commuting miles because when you do a reimbursement, going to the office doesn't count from your home dwelling unless it's somewhere different than your course of business. For an MSP owner, they're traveling from their home to a different client site. Would that considered be deductible or a mileage for business use? Or is it only, hey, I go to the office and then I go in between clients, those miles?
So it's generally if you go in between your office and the client itself. If your home is your office, obviously, then you get to capture all of that, right? So if your headquarters is your home office and you're traveling to clients, then pretty much all of those miles are going to be business miles.
Got it. So we covered home, business use of your home office. We've also covered a vehicle. Now I want to cover, and we can talk about the one that I think most aren't familiar of an accountable plan. What is an accountable plan? I've heard of this. It's a deduction, but what is it in actuality?
Yeah. So what an accountable plan does, it's actually a document that the company would have that dictates how an employer will reimburse an employee for certain expenses, including the two that we just talked about: business use of auto, business use of home. So absent having an accountable plan, you run the risk that the IRS deems all of your reimbursements to your employees as taxable to the employee.
Got it.
So
Got it.
that's why we really want to get these accountable plans in place, so that when you do reimburse the employee doesn't have to pick up that reimbursement as income. The business obviously will still get its tax deduction.
Got it. Got it. So if you're giving mileage, if you're reimbursing for office or computers or a stipend, making sure that you have a documented company policy that's sufficient to say, hey, when I paid Morgan Holmes out his $100 of mileage, it was truly mileage and it wasn't any taxable income. That's all
Right.
that means.
Yep. And if you are giving something like a stipend, so let's say that I give an employee $200 a month for travel expenses or something like that, that's covered under the accountable plan, but you have to give your employer back any funds that you didn't use. So let's say, for example, that the MSP gave an employee $200 of travel expenses. That employee then spent 150 of it. The employee would be required to give the $50 back to the employer, or the entire $200 is then taxable to the employee.
Got it. Got it. And I think this is one where it's really a personal decision. If you want to have, let's say, if your techs are out on the road, having them have a corporate credit card with a limit of it, and then you can reimburse anything additional. I've seen that pretty frequently. So you're not constantly asking your company or your employees for a short-term loan, for lack of a better explanation of it, and just giving them that expense management. But there's always going to be things to pop up. So making sure you have those instances documented. They might be traveling for a conference, or they might be booking a flight because it's just more convenient and such. So I would definitely talk with your business advisor and your accountant to see what makes the most sense for your organization. um is there any reporting requirements? Do they need to report reimbursements, let's say on client or their employees W-2s or anything like that?
Not generally. So, however, if you do have, again, I give in my employee $200 a month, and they don't have to give me that money back, then yes, that $200 a month would end up on the employee's W-2 as taxable wages.
Got it. um Anything, what's a non-accountable plan, actually? Because I know there's accountable plans, but what are non-accountable plans?
So if you're just giving reimbursements to your employees and don't have that accountable plan document in place, then you have a non-accountable plan. And you run the risk that if the service audits you, that they would then deem those reimbursements as income to your employee. So you
All right.
really do need that accountable plan document in place. Even if you're not doing reimbursements, it's just great to have in place, and just in case maybe some one-off transaction or one-off reimbursement comes up, or you're being reimbursed as an owner for an employee expense, you want to make sure you don't run the risk that you're going to get taxed on that.
Got it. And then what about unreimbursed expenses? Is there something with the Tax Cuts and Jobs Act 2017 that changes the unreimbursed expenses?
That's right. So if you're an employee of a business and you're incurring expenses and not getting reimbursed by your employer, currently those deductions are not deductible.
Got it.
So that was part of the Tax Cut and Jobs Act that was passed in 2017. The Tax Cut and Jobs Act will sunset at the end of 2025.
Got it.
And at that point, those unreimbursed expenses will become deductible again. But currently, if you're not being reimbursed for an expense by your employer, you can't take a deduction for that.
Got it.
So
Got it.
obviously better to get reimbursed.
So what are the considerations, real simply, to put an action or an actionable plan or accountable plan into it? What is it? Just obviously, I'm assuming you have to write. It has to be documented. What else around with that? So the IRS isn't coming through and saying, "Hey, this is actually not correct or uncompliant."
Yep. So there's obviously a written plan. That plan requires that employees submit their reimbursements within a reasonable amount of time. Generally, it's 60 days. The employer then pays the employee back. And then again, if the employee is not reimbursing or giving back the employer any unspent funds, then that piece would not be covered by the accountable plan and would be taxable to them.
Got it. So we've covered home, using your home office deduction. We've covered vehicle expenses. We have also covered accountable versus non-accountable reimbursements for employees and plan. Now, the one that I'm sure every MSP owner who travels to conferences and travels maybe a bit of leisure is the travel deduction. I know generally personal travel expenses are not deductible for tax purposes. I know we've talked a little bit this before and 2 weeks ago in the last Stride Live, but just a reminder of, let's say it's a mixed personal and business trip. How can they reimburse or deduct those expenses, if any?
Yeah. So again, we talked about this in a previous Stride Live. So if you have a mixed business and personal trip, the business piece has to be a significant portion of it. So again, generally more than 50%. And then when you have a more than 50% business versus personal trip, the travel portion of it becomes deductible. If let's say, for example, do a 5-day trip, 2 of it is business and 3 is personal, the airfare to that business trip is not deductible. If it's 3 days business and 2 days personal, then the airfare is. And then while you are there at the destination, you then would allocate those expenses, these are business expenses, and for the couple days that I was not there on business, would be personal expenses.
Got it, got it. Yeah, just making sure you have that firm 50%. So don't go for a trip for 2 days and take 3 days off, or you're not able to take the deduction for those 2 days. But you're not either way. If you're there for any leisure, or the personal days will not be able to take. What are some of the other, obviously airfare, lodging? I'm assuming meals, incidental expenses. Let's say, you need to something you weren't expecting. You need to buy a banner for a trade show or something like that. All
Yep.
deductible for business travel, right?
Yep. Cab fare, meals, hotel, airfare, any other ground transportation. Yeah, anything that is business related while you're on that trip generally would be a tax deduction.
Got it. Does education count? Let's say you're going to learn some sort of event in the industry, maybe like CompTIA's ChannelCon, learning cybersecurity. Would that count as business travel, even though it's educational?
Yep, it would. So even if you went, again, 2 days business and 3 days personal, the travel expense themselves getting to the destination would not be deductible, but the event while you're there would be.
Got it. So I think this has been a pretty good stride live in terms of looking for personal expenses into business expense deductions. What's the biggest thing here? I have to feel it's probably around the accountable plan. That's just where I'm gravitating towards. But Morgan, 60 seconds, too long, didn't watch. What's the biggest takeaway here?
Yeah, an accountable plan almost is a must. It's a simple document to put in place, protects the employee and or the owner employee of the business from the service, deeming any of those reimbursed expenses taxable to you. And then, like everything else, document, right? Keep track of it, receipts, document. If you're away on business, what you did, who you did it with, maybe get an agenda for the travel that you did, so that you can prove upon an examination, if any, that in fact the expenses you incurred are business expenses.
Got it. Makes sense. As always, have a plan first, consistently build and conduct that plan, and then always coming back to routinely check, make sure you're following it, make sure you're compliant, and document. Morgan, thank you again for joining today on Stride Live. We really appreciate you, and thank you for everybody who tuned in today.
Yeah, thanks, Casey. Bye
Have a
all.
good one.